Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the fur on my jacket distract you.
Here's the content.
All right. Thank you, Seth. I have to say, how long has this group been around? Couple years. It's called Music and Money, and this is probably the first time you're going to talk about both music and money in the same meeting. So I'll just cover. My name's Jeff Schneider. I'll go over a bit of a background, but real quickly, agenda-wise, how many people here are musicians or artists? So we have a few. How many are investors? All right, so we have a few there as well. So what I'm going to do is kind of cover, I want everybody to be on the same page of just how the music industry works. So the artists, it may be repetitive, investors who aren't familiar with it, you'll probably learn something new that you can talk about over the holidays that is somewhat interesting. So we'll kind of just give a baseline of how the music industry works, and then I'm just going to talk through each side of the equation. So we have musicians who sometimes need to sell royalties, and then we have investors who sometimes would like to buy them. So I'll cover both of those, and then I'll just make sure we leave time for questions. So any lawyer would tell you that you need a disclaimer at the beginning of every presentation. My disclaimer, I'm not a lawyer. I'm also not a musician. And I'm also not your mother. So I can't necessarily kind of tell you exactly what to do. Those people usually have a lot more influence on your actions than anybody else. But I am actually a CPA, so I see we have at least one other of these back in the room. But you know, the thing, let me get started by talking about why royalties were an interesting asset class. So 4 or 5 years ago, I've been an entrepreneur for the last decade or so. Before that, I was in the corporate world. And you know, as an entrepreneur, I never had time to actually manage side investments. I was too busy growing a business. And so, you know, all these people who had investment real estate, like I've met Seth before, and he was talking about, he's got about 7 businesses, but he also has real estate on the side and all of those. I had a lot of respect for those kinds of people because I was always so like heads down into my business that I didn't have time for managing other investments. And the whole idea of real estate as passive income made a lot of sense to me, but every time I went to like find deals or explore, I'm like, hold on, I gotta find somebody to fix the toilet, I gotta put a new roof on the thing every now and then. Like it didn't seem as passive as what I needed it to be if my capacity was 0 from running my businesses. So the idea of royalties basically started seeping into my mind because this is basically something, an asset is created and then it earns royalties each and every time that it's used. So most of the time it's intellectual property. And Warren Buffett has this quote that basically says, the best business is a royalty on the growth of others, requiring very little capital in and of itself. And royalties are basically that. You know, something is created, whether you create it or you buy it, and then once the initial purchase is made, it doesn't need a lot of additional capital. So I couldn't find the exact date that he made this quote, but if I had to guess, it would probably be something related to, you know, his acquisition and interest in Dairy Queen. Like if you think of Dairy Queen is a bunch of individual businesses, but they're all franchises. So if you look at the underlying business of Dairy Queen, it's basically a royalty stream. So that's my guess. And this is basically, between this and some other, there were a couple stocks that I was paying attention to that were royalty businesses. And that's kind of where I started going down the royalty path. So where I ended up, we bought a business called Royalty Exchange about 2.5 years ago. That business had a lot of traction in the music space. So as I said, I'm not a musician, I'm not an artist, I didn't do music finance. So the first thing I had to do was figure out how money works and flows in the music business, like what all these words actually mean. So this may be repetitive for a lot of the musicians and artists in here, but for the investors, I think the first thing to understand, this is going to be like it probably took me 6 months to figure out this one slide. So for anybody who's on the outside, there's actually a lot of nuance behind all of this, but it took me a long time to be able to articulate this in a clear enough way. So I'm going to break this down so that you're not overwhelmed. But anytime you hear music, there's actually 2 copyrights. So there's 2 pieces of intellectual property that earn royalties each and every time it's played. So we're going to use the favorite Christmas song, Chestnuts Roasting on an Open Fire. Does anybody know who wrote that by any chance? All right, so Mel Torme wrote that. So Mel Torme was known for his acting career, but he actually wrote that in I think it was the 40s or the 50s, in 17 minutes in Chicago in the middle of July. So in 17 minutes, Mel Torme wrote down the words. He had a co-writer. He and one other person wrote the words and the lyrics to Chestnuts Roasting on, or the words and the music to Chestnuts Roasting on an Open Fire. And that still generates Mel Torme's estate about $300,000 a year today. So this has been a much more lucrative business for him than his whole acting career that he put 40 or 50 years into. Of course, you don't write a hit on your first try. Any musician here would be able to tell you that. But the first thing to know is that music starts as lyrics and basically instrumental music. That is what's called the composition copyright. So that's here on the left side. So that is the music and lyrics. There's one composition copyright for Chestnuts Roasting on an Open Fire. But when it's performed, was first performed by Nat King Cole, Mariah Carey's done it. There's over 100 other artists that have done Chestnuts Roasting on an Open Fire. They own what's called the sound recording, or what's the master copyright. So there are 2 different copyrights associated to every song. And I think that's important if you're an investor to understand the difference between the 2. If you buy the composition copyright, it doesn't matter who sings that song, you're going to be able to earn money on it. If you buy the sound recording or the master version of the copyright, then you're only going to get that one version. If the same band goes in and re-records it 30 years later, you don't own the subsequent one, okay? So that's one of the first things I think is important to understand. And just for terminology, on the sound or on the composition copyright, the people who service those are publishers. And so when you hear like Sony as a publisher, or you hear a music publisher, that's all related to the composition copyright. What they do is they get people into a room together, to write lyrics, to create music, and then what the publisher does is they go and call all of the labels. They're the ones that actually get recording artists into the studio with a band and with musicians and background singers. That's what a label does. So when you hear labels like Elektra Records, all these others, so that's the sound recording side. Now in today's music world, there's basically 3 of each, and Sony owns both a music publisher and a label. So there's a lot of consolidation that's happened in the industry. But fundamentally, they are 2 different functions. The label is what actually records the album, distributes the album, and they're the ones that print the records. The publisher doesn't have anything to do with that. All right? So, like I said, that's probably the most important thing to start out if you're thinking about like investing in the music business. This is one of the hurdles as I was looking at royalties years ago. I was uncomfortable buying them because I didn't even understand the dynamic between the 2. And one thing that's important is that both of these, the composition copyright and the sound recording copyright, earn money in almost every use of a song. So the splits are sometimes different. The only real exception to that is US terrestrial radio. So that's just like when you go to your car and you play the radio. That's, the composition copyright is the only person that gets paid on that. The sound recording does not. So when Mariah Carey's version of Chestnuts Roasting on an Open Fire plays this Christmas, she doesn't earn any money. Mel Torme earns the money from that radio play, okay? And we can talk about, if we have time, there's definitely shifts of why that matters a lot for investors because of what's happening between radio and streaming. But that's one kind of important difference between the two. Does that make sense? Good. All right, here's another confusing chart. But here we're going to talk about the flow of money. So now that we know the two different copyrights, we're going to talk about the flow of money. So very quickly, let's follow the grayish or blue arrow. So as we talked about, top left, music gets created. So the lyrics and the music, then it goes to the label creates the sound recording or the master copy, and then follow that down, it starts getting distributed out. So that's where it goes to Apple, Spotify, they print the CDs and it goes out to the stores, and then the end consumer starts paying for it, okay? So that's how music flows from the creation to the delivery. And then we're gonna follow the red arrows back, and that's the flow of the money. So this is why, despite being a confusing chart, it actually makes a little bit of sense. So if we're talking about a streaming subscriber, how many people here are like Spotify or Apple Music users? There's not many that aren't anymore. So you're $10 a month. If you're on Apple, for example, you pay $13. $3 of that goes to Apple, and then the rest goes to Spotify. Spotify then takes about 65% of their revenue and they pay out royalties. So I'm not here to be a stock picker, but I can tell you that a business that already automatically gives out 65% of its revenue, I'd prefer to be on the 65% of that equation rather than being Spotify. So Spotify has like a $28 billion valuation. I'm not going to tell you when to short them, but I'm on the short camp. So Spotify gets that, they pay out the 65%. So they keep 35% for all of their overhead, all of their technology, all of their marketing expenses. Then we're going to follow the 65%. Most of that goes to the recording label. So in today's world, so when we talk about the difference between composition copyright and sound recording copyright, in today's streaming world, most of the revenue, that 65% that gets paid out in royalties, is going to the sound recording. So I think it's like 11-to-1 ratio right now. And it'll likely level out closer to like a 7 or 8-to-1 in terms of percentage, but the sound recording, I don't want to say will always, but the sound recording is most likely to be the primary beneficiary of the streaming world. And so that money goes to the label, then the label has whatever deals they have with the artists. So we'll talk a little bit about those next. And then, the balance of it goes to the composition copyright side. And it goes to them through these things that are called PROs. So has anybody here, since you're in Nashville, you've probably met people, ASCAP, BMI, CSAC. So if you've heard of those names, ASCAP, BMI, and CSAC are basically these performing rights organizations. They collect all of the income for people on the composition's copyright side. They collect all of one certain type of income. So we're not going to go through all of that today. But the one thing I will say that was interesting to me about the music business as an outsider, that I didn't know anything about music, is that music is used everywhere all the time, but what you don't realize is that there's kind of these centralized collection repositories that really reduce your counterparty risk as an investor. So if you see the flow of money, you basically see these performing rights organizations and these record labels they're kind of they collect all of the money, and then they're the ones that distribute it out. If I owned a Kanye West song, and I had to go to every bar in the US to figure out who played my song and who didn't, I would never want to own that asset. But knowing that I have people on my side, these large central collection agencies, I'm much more willing to take the counterparty risk knowing that they're out there enforcing my rights. And so that's what the PROs and the labels ultimately end up doing. And so this is a very bad analogy, especially since we have somebody from a title agency in here, but I view like the PROs as kind of a title agency within the music industry. They know who owns everything. That's their role. Their job is to collect worldwide and distribute out to the proper owners. So they're not a formal title agency, but they definitely have a great list and understanding of who owns what. So does that make sense money flow-wise? All right, good deal. One other thing that I think is important to know about like a trend in the music industry is that there's more and more co-writers. So we talked about Mel Torme having one co-writer. In today's kind of like last year in the top 100, 3 had 11 credited songwriters. The average was 4.5. And the reason that you're starting to see that is that in Mel Torme's time, all of this was paperwork, is all paperwork. In today's world, having a lot of that being digitized, there's a lot more willingness to collaborate on the musical side. I shouldn't be talking about artists this way, but it seems the statistics would show that there's a lot more willingness to collaborate because they can understand and they feel confident that they're actually going to get paid their share. So this is good news for investors for a couple reasons, but the primary one being that there's more and more people for every song that you hear, knowing that there's 4.5 writers, that's 4.5 little assets that you could buy. So these things, every songwriter has their own right in perpetuity. They can sell their share without impacting the other 3 or 4 songwriters on that song. So it's just more and more opportunities that are out there as an investor. So we talked about, I'm going to go through each side of here. Why artists sell, so I'm going to talk about that first. There's tax benefits for them to sell. In today's environment, there's a lot more flexibility for them to sell. And they can control that because there's a lot more interest in the music space than there ever was before. So I'll come back to the investors shortly. But for the musicians here, like, why is it that these artists are willing to sell? The easiest way that I describe it is that musicians, it's one of those careers that you don't have, as an entrepreneur, you don't generally get paid a salary. So all of your work is tied up in whatever it is that you've created. And, just like an entrepreneur sells stock in their business from time to time or sells out to a limited partner, it's not to quit what they're doing and go away and do something else, but sometimes it makes sense to take a little risk off the table. And if you don't have a salary, getting a lump sum payment in a tax-efficient way makes a lot of sense for certain musicians at the right time in their career. So in the old days, it used to be that the label or the publisher was kind of the main financier. That's not necessarily the case anymore. If you think about the ecosystem of music, it used to be that in order to be a successful artist, you basically needed to get played on the radio and you needed to be in the record stores. So it was a very centralized distribution structure. And so if you weren't one of the major record labels that could get you into the record store or onto the radio, then there was no point. So you signed up with one of them and you let them kind of manage that aspect of your career. But in today's environment, the listening is so decentralized that you can you can actually focus on marketing your own music. You don't have to have the labels and the publishers do all of that work for you. So you can create it easier, you can control your own marketing a little bit better, and so that's put a lot more power into the musicians' hands than they've ever had before. So, I've kind of covered this. The last thing I would cover here that's interesting for both musicians and for investors is this thing called copyright reversion. So I don't think we have nobody raised their hand who's been a musician for long enough, but there's an interesting part of copyright law that your copyright reverts back to you. So say you signed up with a label 30 years ago, that copyright reverts back to you at the 35-year mark. So if you're talking basically, I think it's like 1982, 1981 right now, 82, 83, I can do math. So if those songs, like if you think of the biggest songs in 1982 and 1983 and 1984, those are all being reverted back to the original owner. It used to be a label or a publisher that owned them. Well, I should talk more. This is more on the publishing side or the composition side. But now they're reverting back to the original owner. That owner has a lot of negotiating power because now they can take all 100% of it. They could sell it to an investor. They can get the publisher to pay them a big upfront fee. They can reduce the admin fee. All of these different types of negotiating power is really reverting back into the musician's favor. So I think it's a pretty good and interesting time for musicians at this point. It doesn't make it easy, but I think it's a good and interesting time for them. So financing options, you'll see a very similar thing to this for the investors. But basically, it used to be a lot of label and publisher advances. You would do admin deals. A lot of times those are what's called cross-collateralized. So if I'm going to create 5 albums and one album is a flop and one album is a hit, they all go together. So I don't get paid on my hit album until the label recollects all of their money from the old album. So private equity deals. So private equity has been a player here since about 2000. I mean, you saw some movement in 2008, but really like 2011 and on, you've seen a lot of private equity deals. The primary reason for them is that most of the investors in private equity are pension funds. And I've talked to a lot of pension funds who they're very direct. They're like, I need 6% a year. That's all I care about. If you can structure anything that gets me my 6%, I don't care what the deal looks like. It needs to be 6% and $100 million or more. That's all they care about. And that's why private equity's played in here a lot, because these are long-lived assets that really match their pension liabilities 30 or 40 years out. So crowdfunding has become more and more popular. I would say I'll be honest, I'm sort of bearish on crowdfunding. I think there's a lot of success stories, but I think it takes a lot more. It sounds good and sexy that fans will pay for it, but I think it's just harder. You have to have the audience base. I think it's just harder to actually implement, both for musicians and actually crowdfunding on the business side as well. I think it's a bit overblown in my mind. Direct sales, so that's what we do at Royalty Exchange. We do everything through, I would say we do most things through an auction format. What that does, we've worked with musicians as little as about $2,000 a year in income, and we put it up. We've got about 25,000 investors who will bid on an open auction platform for these. So that's created a very good competitive price. None of these other ones have competitive pricing. So that's why Royalty Exchange has been able to get a foothold in the music industry. And then third-party advances are out there and available. I typically advise people against them. I haven't seen many favorable third-party advances for musicians in the past. There's TuneCore and a couple others are beginning to offer some decent ones. But that's that. So let's go to the investor side. Any questions before I make a big transition? Any questions on the artist side? There's only a few of you here, so.
I was just wanting to ask you real quick on that 35-year reversion deal. If you buy the royalty stream, do you have, are you buying it in perpetuity, or is that reversion going to happen? Let's say you're 20 years in. Yeah. Is there 15 years left before it reverts, or how does that play into this?
Yeah, good question. And if it's one thing to be more aware of on that composition publishing side of things, But yes, if the song is 20 years old and you're buying it, there's a good chance that it's going to revert back after the 35 years. And then, like, if you own it, like I said, you can try to negotiate with the original creator at that point and things like that. But what we do at Royalty Exchange, when we know that that's the situation, we put the term on it and try to make sure it's transparent and available for the investor making that decision. Because certainly you make a different decision if you're going to own it for 40 years versus longer than that. All right, so why investors buy? I'll cover this, but basically it's depending on the individual income stream. It's a great diversification asset. So if you look at the economic cycles along with the music cycles, basically zero correlation between the two. So it's a diversified income stream. The right royalty streams are stable. And the biggest thing I would say is that they're cash-based. So I invested capital into private businesses and public businesses. The thing I hated about it is that if say it's a private business, they could generate $1 million worth of income, but it's still up to them if they want to dividend that out to the shareholders. And you have to pay taxes. So it's like the business could be extremely healthy, but your position as a minority shareholder still didn't mean that you actually generated cash. I'm a cash flow guy. Like, I want cash in my pocket, not just assets that claim to be appreciating in value. And so royalties give you that. You get paid on a quarterly or semi-annual basis. It's 100% cash. You have direct right to it. Nobody else has claim on whether you get it or not. It's a very simple transaction. So that's one of the biggest things that attracted me to music. But when we talk about correlating assets, it used to be, we've got some financial advisors here, but it used to be that stocks, bonds, you had a diversified portfolio, and you could be somewhat healthy. Gold was kind of an hedge against the economy. But ever since the 2008 correction and recession, what you've seen is actually these correlations have continued to increase. So what used to be not correlated or uncorrelated are now becoming more and more moving in tandem. And the primary reason behind that is just the debt fuel that puts everything. So everybody takes out the debt and buys all the assets. So asset prices go up, and over time that just makes things move in a similar fashion. So when I was looking for these alternative assets, knowing that all of these things are beginning to move in tandem made me nervous. That's part of the reason why we were looking at music royalties. So I would imagine most people here are familiar with kind of basically just alternative assets. The whole goal of alternative assets, getting things out of stocks and bonds, is just to get the same amount of return for less risk or get an increased return for the same amount of risk. That's all that's saying. It's a pretty chart for that. This is a much smarter guy than I, who's done a lot more research than I have, who did a lot of the economic comparisons between the music industry and the economic cycles, and his conclusion is that they don't go hand in hand. And I can tell you that if you look at the last major economic cycles, we'll talk about them here in a second, but the music industry totally missed both of them. So right now, I think, is when we're actually starting to see the upturn in the music business. 4 main reasons why music royalties are a great asset class. The first is consistent, stable cash flow that we talked about. The amortization tax benefit. So for anybody here, I saw a few real estate investors. You're familiar with depreciation. So basically you buy a property, you get to depreciate it, in most cases over 20 years, or depends on the acceleration you choose. With music royalties, you can amortize the purchase price over 10 years while you're getting the cash flow. So it's a very powerful tool that, believe it or not, I used to have lots of skepticism towards investment bankers, but this is one of the transactions that is actually, value is created by doing a transaction. So for the rights holder, the person who owns the copyright or created it, they get to switch from ordinary income to capital gains when they sell their royalties. So if you do a very simple cash flow model and you generate $100 a year and you're taxed at 35% because it's ordinary income rates, if you decide to sell in year one at only a 6 times multiple, and you just reinvest that in treasury bills, but you're paying a capital gains rate, it's a positive NPV for the seller in that situation. So that's one of the big reasons why larger sellers come to us. It's just a tax arbitrage strategy. So the seller gets their own tax benefit, and then the buyer gets 10 years of tax benefit. So it's done using what's called the income forecast method. So it's not a straight line. So I know most real estate is straight line. This uses what's called the income forecast method. You can look it up. It basically means you just, when you buy it, you estimate what it's going to earn over the 10 years. And if you think it's going to earn more in year one, you take more amortization in year one, less in year 10. It's not overly complicated. So the question was, do you recapture that when you sell? The answer is yes. Basically, your cost basis as you amortize goes down, and when you sell, you basically get a capital gain. But the reason why there's tax value added here is if you, Congress on the seller side, the musician who's looking to sell their rights, if I was a publisher as a business, I own the same rights as the musician, but I usually keep 50% and give 50% to the musician. When the publisher sold their rights, they would get capital gains because they're a business. When the musician sold their rights, they were having to pay ordinary income. So Congress basically put in one of these special tax loopholes that gives the musician and the creator the same tax treatment as the publisher. So this is one of those transactions where if you're the investor, you may think about holding it forever, but there may actually be value at the end of the 10 years to sell, recognize capital gains, and then go buy basically something that's the exact same that you get the amortization benefit for again. So long-lived assets. So the copyright is valid for life of the artist plus 70 years. And it's actually life of the longest living artist. So anybody here know DJ Khaled? Few? Okay. So DJ Khaled is he's a musician, written a lot of hits over the last couple years. I would say produced a lot of hits over the last couple years. And he actually started including his 2-year-old son as a songwriter on his songs. And he may have done it just for fun because he's DJ Khaled and he thought it was cool. But if you actually think of the business standpoint, I really don't know what his intent was. But he actually just extended the value of the copyright for an extra 35 years. So, so it's actually smart what he did because the copyright lasts for the life of the longest living contributor to that work and 70 years beyond that. So by adding a 2-year-old who evidently ideally will live longer than any of the other creators, he's extended the life of that piece. And then I have relative price stability here. I think the main thing for me there is that these things trade on multiples in the same way almost anything stocks or real estate does. Real estate trades on the inverse of a cap rate. But the easiest thing to think about is that you're collecting cash and the multiples may move up and down over time. And the cash flow may move up and down a little bit over time. But ultimately, the asset doesn't actually deplete. So since it is a 70-year asset, you have a lot of time, and some of the premium things are going to trade at a 10 multiple today, and they're going to trade at a 10 multiple 10 years from now. And so if the cash flow is relatively stable, you're just going to collect 10 years of cash, you're going to get 10 years of amortization, and you're going to have an asset that's relatively stable at the end of it. So that's what I mean by that. So let's talk about, I kind of gave a little bit of insights of the trend of the music business. When we looked at all of the different royalty spaces, we looked at like energy, we looked at intellectual property. We chose to stick in the music industry at first with Royalty Exchange. And the primary reason is that we saw the music industry really cutting a corner. So we bought it at the end of 2015. And when I start showing you some charts, you'll see what I mean. But this is a quote from a Goldman Sachs that basically says, the last 15 years of the music industry have all been about value destruction. The next 15 years is all about value creation. And you'll see that all in the charts. So the first chart here basically shows from 1999 to 2014, the music business almost getting cut in half. And that's basically as Napster came out. I mean, that basically led people buying less albums. People were just downloading them for free. To combat that, Apple came out with iTunes, which really did help, but it couldn't cut it enough because now rather than spending $11 or $12 on an album, you paid 99 cents for a single song. So it helped, but it didn't solve the issue that the music business was running into. So that basically cut deep into the music industry. So when I talk about the music industry's missed out on the last two economic booms, it started feeling pain in 1996 is really when Napster first came out, but it got big in 99. So you missed out on the dot-com boom, and it's declined all the way through from 2008 to 2014 as kind of economic recovery started picking up. Music industry totally missed it. It kept getting hammered every year after year after year. Underneath all of that, we started seeing the red and light blue is the digital and streaming rights. And you see basically how those grow over the last few years to really pick up for the decline in music. And so from 2014 to 2017, you see the music business going from 14 billion to 17 billion and really starting to accelerate the pace. So just as a random fact, I didn't put this slide out there, but right now there's about 112 million paid subscribers on Apple or Spotify. These are paid subscribers, not free users. And that is basically a 3% penetration into what everybody assumes is the smartphone population and people who can afford to pay for the streaming right. So here in the US and Sweden actually, Sweden is like the model. So Sweden has about, I think it's like 90+% penetration. They're not expecting that, but for the industry to really grow significantly. So you see here, this blue line, that's the streaming line. Call it $4 billion in 2015, 2016. Goldman expects just that streaming line to be 28 billion. And that penetration rate, not 90% that you see in Sweden or 3% that we're at today, that's about a 14 or 15% penetration rate. So you see what streaming can really do to the music business. And that's also why I started this by talking about the different rights, because we talked about streaming mostly benefits that sound recording side. And if you look at the last 40, 50 years in the music business, most of the music business places most of its value on the composition copyright side. So the composition copyright side often trades at a higher multiple than the sound recording. And I think there's a lot of opportunity in the sound recording side because of what we have here with streaming. So this is just talking about kind of this evolution in the music business. Now that we have transparency in the digital, like we're not having to worry about how many CDs get shipped out and then how many CDs come back, and all the inventory counts at all these other stores. It's all just digital storage now. So as long as it's not Jay-Z's streaming, what's Jay-Z's streamer called? Tidal. As long as it's not Tidal data, so Jay-Z and Tidal got caught manipulating all of their streaming numbers a couple months ago. So that was a bad idea on their part. But generally speaking, you can catch it much easier if it is manipulated. They caught it within a few months. So if you're an investor sitting here asking yourself, how do you invest in the music space? I of course have a bias. I'm not going to sugarcoat that. But there are private funds out there that you can invest, like Roundhill just bought Elvis's catalog. They were out doing private placement fundraising rounds for it. Direct royalty exchange auctions, royaltyexchange.com. You can check out all the auction listings. I think they just had 3 end yesterday. So there's usually 3 or 4 auctions a week. I encourage everybody to, when you sign up, don't bid on the first auction you look at. Don't fall in love with it. It's just like any other investment. You have to get the data, analyze the data, get familiar with how it works before you make a bid. But that's a direct, and the direct way is one way to also make sure you get that tax amortization benefit. Public markets, Spotify, I've told you my opinion on them. But if you want to invest in the growth of the music business, it is there. Spotify is a beneficiary of the growth in the music business. I just would prefer to own the underlying asset and not just be the utility. Sony royalties are, just for your knowledge, Sony's are, it's about 7 or 8% of the total conglomerate is just Sony Music. So if you look at Sony stock, just know that it's a small percentage. Vivendi owns Universal, which is Universal's one of the 3 major labels. Warner is the third. So you have Sony, Universal, and Warner. Warner is not a publicly traded company, but they have debt that you can buy. So they're private, public reporting. You can do your analysis, but you can buy their debt if you want for a fixed interest rate. And if you want a really strange, unique stock, I would encourage you to go look at it. I'm not encouraging you to buy it. It's actually very difficult to buy. It's called Mills Music Trust. So it was actually like, I think it's Paul McCartney's and this guy named Mills, who used to be a music producer, but it's basically in runoff mode. So it's not really an active business, but they own a lot of copyrights, and it's generating royalties. So that's one you could look at if you just want to understand it a little bit more. And on the lending side, there are places you can do direct lending as well. Royalty Exchange has a bit of that. Anybody here ever heard of Bowie bonds? No? Okay, so in the same way that Warner Music has debt, there are some celebrities, and there was basically some securitization of musicians' royalty streams. David Bowie was the first one to do it, and other people have done it since. So some of those opportunities are out there as well. And that's all I have for now. Any questions that I can help field?
I was just curious to know if you know how Prince's catalog is shaking out.
So, well, Prince's catalog from an income standpoint has done well. I don't know how fatalistic to be in this presentation, but there is a real thing in the music industry called the death bump. And that is when somebody dies, the music, their consumption of their music increases to the point that it's really worth about a single multiple as an investor, at least the analysis that we've done. It's worth about a single point on the investment. So it is a real thing. So on the income side, he's done well. From a structural standpoint, his estate was not planned very well. So there's a fair amount of dispute in his estate, and I think that'll continue on for a while. So my understanding is we're probably even a couple years away from being able to talk about much with his estate.
So I should buy Willie Nelson's catalog?
Well, Willie Nelson's still touring, but yeah, I mean, so if as an investor, I think
buy the aging artist.
I think if I were to provide any insights as an investor, I think I'm more drawn to paying a bit higher multiple for more stable cash flow streams that are a bit older. You can certainly get newer cash flow streams, a bit more volatile cash flow streams at lower multiples. But my whole intent and idea around music royalties as an asset to invest in, it is the more established artists, the people who have been around for 20 years. Like I said, the interesting thing with Willie is that he's actually still on tour every year. But yeah.
The real question was on the life cycle of songs, because they all crank up real fast, and then they kind of die over time. Is that public knowledge as far as the expectation of income generation of a song based on streams and plays and all that? Because, I mean, you know, who knows, you know, how many times is Achy Breaky Heart going to be played 20 years from now?
Yeah, so that's a great question. So you talked about basically the life cycle of a song. As an investor, I tend to stay away from a song that's less than 4 years old. So our analysis at Royalty Exchange, and we haven't released a lot of this because, as I said, I'm not a lawyer, and this is where the disclaimer comes in. But we have to be careful what we do as a market and what we present. So I'm here talking as a small group. But you know, I think the thing I would say is that the analysis we've shown is that a lot of that variation, think of it as like an oil well, does the same thing. Starts off strong, kicks down. A lot of that variation we've seen happens in the first 4 years. So it's a little less than that, but by the time you do payment cycles and things like that, it's about 4 years long. So after the 4-year mark, you start hitting a bit more stable of an income stream. And there are little anomalies here and there where music gets placed in a movie or things like that that may pop it up. But what I would generally say is after the 4-year mark, you may have a more stable decline rate. So maybe your decline rate's 2 or 4% a year. But it's at least predictable that you can model it out. And then I think the other interesting thing with music is that you do have what we call kind of like a right tail risk. So your risk isn't at that suddenly Achy Breaky Heart will go to zero. What you may end up with is getting it placed. So it may actually be more positive surprises on out years than negative surprises. So assuming you model it well from day one.
So if somebody wants to go ahead and they know nothing about investing in a catalog or anything like that, and they go to your website, and so how do they know how to analyze? How do we learn how to analyze? How do we see, hey, this is a good deal or not? Is that a resource that's on your website? Because it's not common knowledge. Like most of us, even though we write and all this, we have no idea whether a song is going to do good or how to calculate, how much to pay for it, especially if it's in an auction.
Yeah. So I think a few things I would say is I'm a data-first person, so I think everybody invests differently, but my preference is always to go get the data. We provide all of the data on all of current auctions and past auctions. So you'll be able to see the start price, the end price, the earnings. You'll be able to download every single line item of earnings data. So you can see how much Spotify paid versus how much Apple paid versus how much came via radio. So I would encourage you to break those things down, first of all. So just go gather the data. It is out there, at least on the Royalty Exchange site. But if you're looking at private deals too, like I think those are, having data from any source is better than having no data from nowhere. So I think start by gathering the data. You'll see the average multiple on Royalty Exchange, this is very broad, but the average multiple is about 5.8. Times last 12 months earnings. So, but that varies. Like we had one end that was, at just over 1 time because it was a new song, highly speculative in that kind of like peak earning year. And then we've had things go for almost 20 times. It was like a country song that was 35 years old, and like the cash flow stream looked like an annuity. I mean, it had plus or minus 3% variation quarter after quarter. So from there, I just think gathering the data. I do data by source. I think that's one of the most important things. So you figure out how much radio contributes versus streaming, and then look at the growth rates underlying it. So it's old school cash flow analysis, a bit more complex than like a real estate cash flow analysis, which is just like your vacancy rate and your rent pricing. But, and then from there, the folks at Royalty Exchange, you can call them, talk to them, ask them questions. And I think that's probably one of the easiest ways to learn.
What would you say is the average return on somebody that used to buying, 5, 6, 7? Are they getting, you think, a 5% return, a 6, 7, and 10? What would you say that is?
Yeah, so Royalty Exchange has only been around for 2.5 years in its current format, so it's a little early there. But if you look at music royalties as an asset class, and you look at a lot of the studies around music royalties, it's around 13%. And part of that is because of the tax benefits. That 13% includes the tax benefit. Yeah.
That's great. Sounds
And
good.
just the big thing I'd say is that's you make that on the buy, right?
Mm-hmm.
So I will tell you, everybody here, one of the largest risks of investing in music royalties is you buy it and then you literally can't do anything about it. So making sure you buy at the right price is an important one. So it's the same thing. Real estate has its own kind of location risk and things like that, but there's not a lot you can do to do like a turnaround.
So as far as like selling, and you own it for a few years and you want to sell it, so sometimes it's just not as easy to unload. Basically, is what you're saying.
Yeah, I mean it's an inefficient system. So it's more inefficient than real estate. It's more inefficient than stocks. So there is basically some cost to trading. In real estate, your cost to trading is 3%, 5%, 6% brokerage fees.
Like those.
If you're a broker, you like those. Yeah, but those are basically costs of trading. In this space, your cost of trading is probably, right now in today's world, is closer to 10%. So there is a cost to that.
I've got some questions if none of you all have any. First thing is, for an investor, what is the entry point? Is there a typical entry point? I know people are always asking when they come to our group, when they watch online. They may be new investors, so they may not be accredited. They may not have $100,000. Well, that's a good question. Do you even have to be accredited to participate as an investor, and what is the entry point?
Yeah, so you don't have to be accredited. Almost all of the deals that Royalty Exchange does are 1-to-1, so you don't have to be an accredited investor. But the entry point, I'll say the real entry point, and then I'll also say kind of the nominal entry point. The nominal entry point is there are auctions that start at like $5,000. The thing I would say is that there is a real laddering, I guess. I don't know the right way to say it. But at a certain point, after you get above about $50,000 in nominal dollar value, I don't want to say the multiples go down, but your competition at auction goes down. Because there are a lot of people who are interested in buying kind of their entry point at $5,000 or $10,000. So they'll put in higher bids on a multiple standpoint at the lower amount that they wouldn't put in at 50 or so thousand. So we do kind of see a step basis there that I would just want to make sure that you're aware of. Just some people have told us at the lower values that they literally just want to learn, and they view it as, I'm going to put $250,000 into this, but I just want to go through the process once. So if I go through the process at $10,000, I just want to see what it's like. I want to see everything, how it works, get paid a few times, and then I'll come back and do other auctions at higher amounts. So it's how you learn, but I just want to be very transparent that those lower ones usually have a lot more competition at auction and some very irrational players. So one of our smaller auctions, like the guy was bidding an absurd multiple, and we actually called him and we said, like, you understand you're probably never going to make your money back? Like, we were very direct with him. And he said, yeah, my daughter got engaged at this band's concert, and I'm buying this for her as a wedding gift. And so that way she'll get paid forever into the future, So he's like, it's a gift. So he was totally an irrational player in the market. And if you're on the other side of that person bidding, hopefully you're not as irrational. So you never know who your competition is within an auction. So that's why that doesn't happen at the higher dollar values. So yesterday we ended one at like 370 and another one at 108. But on average, across about 200 or so deals, we're at about 70,000.
Yeah, so no investor left behind. We always say that. accredited investor, basically what that means is you have to be, and correct me if I'm wrong from CPA, but you have to be making $250,000 a year or have $1 million net worth in investable assets, excluding your primary residence. So basically just means a higher entry point, not where you're going to start right out at. One question, just to go a little deeper into maybe the benefits of, if there's any artists watching, songwriters watching, I don't want to skim over this because there's a significant strategy to why you would even want to sell. That may be a big question that people have. Why would you want to sell if you're making this stable cash flow every year? The country song, you think about why would you sell something when you have this coming in solid every single year? Well, there is a massive tax benefit that you get that can ultimately wind up helping save in a long time. So maybe can you reiterate just the purpose of why an artist or a writer or creative would even want to sell?
Yeah, I think the sophisticated ones are because of tax. And so there is tax arbitrage there that they can flip their ordinary income to capital gains. So
and in numbers, that means?
That's basically 35% or so, depending on what state they live in, down to about 20%. So almost cutting your tax rate in half. And so that is a real strategy, as I said, and it's not every single person can do it. So just if you have questions, just ask. But then I think the other one is that it's a real financial decision. You know, I think any financial advisor, anybody who's giving you advice, whether you're in the music industry or whether you're in any industry, if 100% of your net worth is tied to a very single thing, one of the best moves you can make is take a little bit of money off the table, take a little bit of risk off the table, get a tax benefit out of it, and you don't have to sell 100%. So I think that's one thing that musicians often come to us, like, it used to be that you had to sell 100% or you sold nothing. And if you're dealing with private equity, that's often the case. But you know what we work with a lot of musicians who just want to take a little bit of money off the table. They either want to build a new studio for their career, or they want to go, like we've had people who go put it into rental real estate just to diversify outside of where 100% of their income comes from.
Yeah, that's a great answer. Is there any other question? Yeah, because I could just keep asking questions all day, but I'm sure you guys have lots. So Chris Picciurro in the back with a question.
Okay, not to get too tax technical on this, but just thinking through the artist's perspective. If they, first of all, is there a step up in basis on these assets if they pass away? And does your company get involved with valuing that? I'm thinking if I have a client that's an artist, unfortunately passes away, and their beneficiaries want to sell the catalog, I want that step up in basis. Do you guys get involved with valuing, et cetera?
We don't get involved in valuing. The step up in basis is an interesting question. So ultimately, when somebody dies, the value, whether it's a stock or business that they own, basically passes on to the heirs at whatever the value of their death is. So this is when we talked about the death bump. That's one of the debates that goes back and forth between the IRS and the estates, is what the value is. So I think we don't get involved in valuing is the end, but they do, yes, get a step up in basis upon death of the artist.
Can you talk a little bit about, just because, and this is a little bit unrelated, but might be a question that other people have. Can you talk about, you kind of glossed over it. Royalty Exchange was a business that you acquired, a business that you bought. That's something that we haven't talked a lot about in our group, but can you walk us through the process of literally buying a business? How long is it from you coming up with the idea that I want to buy a business, evaluating all the options that are out there, all the different marketplaces, and then actually closing on it, and then how is it financed? How do you make sure that you're going to, earn at least what it has projected it's going to earn? Maybe just walk us through the process of even that, because that's very interesting to me.
Yeah, this is, to be honest, this was one of the more simple sides of acquiring a business. So we actually bought the assets of the business. So I think the first lesson for anybody who's looking at acquiring is the first decision you make outside of who you want to buy is how do you structure the deal. We structure it as an asset purchase. The owners before us, we didn't have confidence in their equity capital table and their debt structure, so we didn't want any of those liabilities to be moving on with us under new management.
Can you explain that in kindergartner language?
Yeah, sorry. So basically, we bought them in distress. So they had some financial issues, and we knew they had debt. We knew they had other investors. In order to get the deal done, we would have had to have either won over the debt holders with our new plan, won over the shareholders to get the right votes, and all of that seemed extremely complicated. And rather than having, say there's a debt that's out there that we weren't aware of on day one when we acquired, if we would have bought the business, the liability would have moved on to us as the new ownership. And so even whether it's credit card debt, whether it's some random person sitting in the middle of North Carolina where we bought the business from who claims they lent them $50,000, if I couldn't have faith that I had a full diligence and understanding of all of the outstanding liabilities, all of the current shareholders, then you should almost always structure it as an asset purchase. Because the asset purchase, they do with the business whatever they want to do. You give them cash in exchange for assets. The assets are free and clear. So I hope that helps, but that was the first decision that we had to make. From there, I think I would always expect the process to take longer than you expect it to take. So I can't say we were looking to acquire them, to be honest with you. We were interested in royalties. We were following what they were doing. And as a relationship built with kind of the current management team, they basically said that they wanted to raise some money. So we looked at actually investing in the business. We realized that it's not an investable business for the reasons I mentioned. But we were interested enough as operators and entrepreneurs of businesses. We saw things that we could improve upon and momentum that we could build off of what they started. We came up basically with a price and of where we felt it was pretty risk-free for us, and we could make the improvements that we needed and invest into the business where it needed to be invested in.
That's good. So having owned and operated this for 2.5 years, what are some of the mistakes that have been made along the way that maybe investors can learn from, that artists can learn from, but even just from people who are running this type of a business? What are some of the mistakes and things you've learned from them? Yeah,
I think the biggest one from the investor side is really the overpaying, and that's getting emotionally caught up in an auction format. And so I'm a big fan of do your analysis, set your price, and bow out whenever the price gets hit. It doesn't matter whether it's Barry White or Gloria Estefan or whoever your favorite artist is. There may be a little bit of value for you to own something that you really like and enjoy, but in the end, it's an investment, it's a cash flow stream. I think as an investor, you have to be pretty unemotional about that. So I think that's one of the biggest that we see. From there, I think on the musician side, I think probably the biggest thing that holds things up, musicians sometimes have right of first refusals with their labels or publishers. But the good news is Royalty Exchange has been able to help them get a better deal with their label or publisher. So I think on the musician side, I'm not a musician, so it's hard for me to give a lot of advice to them outside of financial advice. It's hard for me to give them career advice. I'll be honest.
Yeah, it's good. Any other question for Yeah, Brian?
What is the process like once you've actually acquired a royalty on Royalty Exchange? What does it look like? What is the paperwork like? What do I do to actually get my money after I've purchased this?
Yeah, good question. So typically takes about 2 weeks, but there's a purchase agreement. The purchase agreement is between you and the seller directly. So you review that. That's pretty standard and templated at this point. And then from there, we work with whoever the paying agency is, whether it's ASCAP, BMI, or a label. They all have somewhat separate processes, and we just set you up as the new payee and as the new owner. So we do everything under what's called an irreversible letter of direction. We don't work with the paying agencies that don't recognize irreversible. So that's one thing to just pay attention to if you're ever going to go do a private deal. For us, we want to make sure that when the title, it's not an official title, but when the title transfers to you as the investor and the new buyer, that the artist can't go and say, hey, that's my music. I want the money to go somewhere else 5 years from now. So we only operate with people who have the irreversible, irrevocable letter of directions. But that's really it. If there's a purchase agreement, there's a letter of direction, and then the next payment comes to you. So we do everything. We do everything in as simple as a way as possible. So we don't, in most deals, we don't do it like an accrual basis. So like if it transfers today, and the next payment's a month from now, that they earn the first month and then you earn the second month. We just say any payment after today goes to the investor. And we're upfront with the sellers on that as well. It depends on the paying agency. So ASCAP, BMI, I would say most things on the composition side are either monthly or quarterly. From the label side, most things are every 6 months.
It's good. Are there, obviously we talked a lot about music royalties. Now, that's just scratching the surface. There might be people who have written a book who have book royalties. There might be.
We've done those.
You've done those. Done all of the above.
Yeah.
Is it any kind of royalty stream that people can sell?
So, yes and no. I mean, yes, any royalty streams are, in the end, is cash flow. So to me, cash is widgets. I could care less what it comes from as long as I can analyze what it's doing and what it's going to do. So any deal would be looked at. The important factors are, is title clear? Can it clearly be transferred in an irrevocable fashion? So we have done books with like people who have Amazon publishing, other publishing, but the first call we make for anybody who has kind of a unique royalty stream or intellectual property that they own is figuring out if there's clear title and if we can transfer it cleanly.
What are the things that would stop somebody from being able to sell it? Is it just something that's in a contract that they might have, a publishing contract, a record deal, a book deal?
Yeah, so it's all contractual. Some contracts literally have a no assignment clause. So we look for that first. From there, after, if there is assignability, which most contracts do have assignability, but there are some out there that don't. From there, we look at if they'll recognize it in an irrevocable fashion. And the other thing would be the matching rights. So there are deals out there that are rights of first refusal. So what we do in that case, if there's a right of first refusal in their contract, when we review it, we'll reach out to that organization that has the right. We'll see if they'll waive it in advance of the auction. Most of the time they'll waive it in advance. A lot of the labels and publishers, their margins have been so compressed for basically 99 to 2014, even though they're getting fat margins now, but it's in their blood to not be buying these things at this point. So a lot of times they'll waive them right away, but in some situations, like there's been one recently where it went to auction, they didn't waive the matching right, it went to auction, got a price that they were willing to pay, and then they matched. So the seller got a better deal because it went to auction and got a fair price, a competitive price. The only unfortunate part in that situation is the person who was planning on buying it didn't get the investment. But you'll see in any of a royalty exchange listings at least you'll see if there's a right of first refusal, so that when you're bidding, you'll know that it could go away. Yeah. But that's actually the only time we've had the, out of about 200 different auctions, that the matching right's been executed on.
Yeah, so good piece of advice for creators and songwriters and authors and anybody that's creating. Probably a good idea to evaluate that on the front end when you're maybe evaluating, should I sign a publishing deal? Should I sign a record deal? Make sure that you pay really close attention, or that you at least have a good attorney who, any competent music business attorney will know to look for this, but make sure that you're covering those bases on the front end, because you want to be as free, no strings attached as possible, should you ever need the money, or should you ever just decide to sell for whatever reason.
Yeah, I think for those contracts, and I'm not the expert in these, but certainly we talked about reversion is statutory. It's mandatory after 35 years, but a lot of contracts it's much shorter. Like you can get reversion after 15 years contractually. You can sign a 10-year admin deal that basically everything reverts back and everything's renegotiated every 10 years. So I think those are important factors in my mind for a musician, is know what your admin fee is and know how long it's going to be. When do you get it back?
All right, let's give a warm hand clap to Jeff for such a great presentation this morning. Thank you. So good. Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.